Hey everyone, welcome back to Corporate Decoder, where we crack open the financial secrets of the business world. And today we're diving into a filing from Digital Brands Group Incorporated. Get ready because this one has a few twists and turns involving preferred stock and some interesting amendments. Before we jump into the nitty-gritty, if you love getting straight to the point insights from these complex corporate filings, do us a favor and hit that subscribe button. We also have a fantastic Discord community linked in the description below where we break down these reports further and discuss market trends together. Join us. So what exactly are we looking at here? This is a current report on Form 8K, which means the company is announcing some pretty significant timely information. The main event here is related to a private investment in public equity or PIP. You can think of this as the company selling shares directly to a few big investors instead of out on the open stock market. The company had previously announced a deal back in August with some investors for what they call Series D convertible preferred stock. Now, preferred stock is a bit different from common stock that most people are familiar with. It often has special rights or privileges. These shares were set to convert into regular old common stock, but at a price that depended on how the company S common stock was doing on the market. The initial deal raised about $11.2 million for the company. But here is where it gets interesting. On the 23rd of September, they amended that original agreement. This amendment brought in more money by issuing an additional chunk of that Series D preferred stock. More importantly though, they changed the terms of that preferred stock. They increased what they call the stated value of each share from $1,000 to $1,150. Think of stated value as a sort of baseline worth or face value for that preferred stock. This amendment also pushed back deadlines for filing paperwork related to registering the shares for sale. So, on the 26th of September, they had what they call a second closing, where they finalized the sale of these additional preferred shares. This brought in another $1.5 million. The total stated value of the preferred stock sold now adds up significantly, with each share now valued at that higher $1,150 mark. And there is even more. In addition to the preferred stock, some investors also decided to use what are called warrants. You can see these as options that give the holder the right to buy company stock at a certain price. These warrants brought in another $300,000 in cash. It looks like they are trying to raise capital from multiple angles here. Just a quick note on who helped make this happen. A firm called RBW Capital Partners acted as a placement agent. They were paid a fee, which was 8% of the money raised in this second closing. So for that $1.5 million raised, that is a pretty decent commission for them. Now, a key point here is that these securities were not registered with the SEC. This means they were sold under specific exemptions, often because they were sold to accredited investors, who are typically institutions or high net worth individuals. It is a common way for companies to raise money quickly without the lengthy process of a full public registration. Let's go back to that amendment of the preferred stock. This filing also details exactly how the company changed the rights related to this preferred stock. Not only did they increase the stated value, but they also increased the total number of Series D preferred stock shares that the company is authorized to issue. They went from being able to issue 15,000 shares to now being authorized to issue up to 17,500 shares. This gives them more flexibility to issue more of this type of stock in the future if needed. And tying it all together, these changes to the preferred stock required formal amendments to the company's official documents, like its certificate of designations. This is more of the legal housekeeping side of things, making sure all the paperwork matches the actual business decisions. To let the public know about all these dealings, the company put out a press release on the 24th of September. This is pretty standard practice when companies make significant financial moves. They want to keep their investors and the market informed. And if you really love diving deep into the legal language, all these documents like the amendment to the preferred stock terms and the purchase agreement itself are attached as exhibits to this report. It is where you'd find the precise wording of every agreement. Now, let's look at what this all means for Digital Brands Group. The company is actively raising capital through various means, a PIPE offering with preferred stock, and the exercise of warrants. They've had to adjust the terms of their preferred stock, increasing its stated value and authorizing more shares. This suggests a potential need for more funding. The fact that they are extending deadlines on registration rights also hints that they might be navigating a complex path to get these shares into the hands of public investors, or perhaps dealing with market conditions that make immediate registration less feasible. The key takeaway here is that Digital Brands Group is in a phase of seeking significant funding. While raising money is often a good sign that a company is trying to grow or execute a strategy, the specific structure of this deal, involving preferred stock with adjustments to its stated value, along with warrants, indicates a degree of complexity and perhaps a pressing need for cash. They are using mechanisms that are common but also often come with their own set of conditions and potential future impacts on dilution for common stockholders, especially if those conversion terms kick in unfavorably. We don't have specific financial tables to analyze in this particular report, as it focuses on these specific transactions. However, the story it tells is about capital raises and adjustments to equity instruments. It suggests the company is actively managing its financial structure to support its operations or growth initiatives. So, what is my take? Digital Brands Group appears to be aggressively pursuing capital. The amendments signal they are willing to adjust course to secure funding. The risks here lie in the terms of these agreements and how they will ultimately affect the value of common stock if conversions occur. The opportunity is, of course, if this capital infusion truly fuels significant growth and a strong turnaround for the company. It is a delicate balance, and one that investors will be watching closely. Alright, that is our breakdown of this particular filing from Digital Brands Group. What is your take on these capital raising maneuvers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate filings. And don't forget to check out the Discord link in the description for more discussions. Thanks for watching. See you next time.